Checking in on business news now, the Federal Reserve approved another 0.75 base rate increase on Wednesday. So the federal funds rate has now gone up 0.75%. That puts the federal funds target rate at a 15-year high. Just 1 year ago, the target rate was a fraction of 1% and has skyrocketed over the past 10 months. The last time the federal funds rate was above 3.8% was the middle of the Great Recession the beginning of the Great Recession, in 2007 and 2008. Federal Reserve Chairman Jerome Powell yesterday didn't exactly sound confident on these rate hikes ending anytime soon. Also didn't sound too confident on whether or not this would help and stop the U.S. economy from heading into a tailspin and a recession.
I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And, our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
NewsNation business contributor Lydia Moynihan joins us now for a look at what the latest rate hike will impact. And Lydia, I got to imagine this is going to impact the housing market first. What does another rate increase mean for those looking to buy?
Yeah, these rate hikes are impacting essentially every piece of someone's financial architecture. And of course, one of the most painful ways we're experiencing that is with the biggest purchase, the biggest loan most people take out in their lives, and that's for mortgages. And we're seeing mortgages rise in direct correlation with what the Federal Reserve is doing with interest rates. At the beginning of the year, interest rates, as you mentioned, Mitch, were close to zero, and mortgage rates were well under 3%. Now, as the Federal Reserve begins this aggressive rate hike, roughly 4% interest rates across the economy, we're seeing mortgages surge above 7%. And Jerome Powell signaling yesterday that interest rates could go even higher than expected. And there are some experts who think that that would mean mortgages in the next year could be north of 9%.
Well, I think that's the key, right? Is we both talked yesterday. We thought the markets might say, hey, this is baked in for November. But some had suggested that maybe this would be enough, that Jay Powell would pause the interest rate hikes. He did not give any indication of that. The Fed meets one more time this year in December. He kind of hinted that they're going to raise interest rates again and that there is no end in sight for the raising of interest rates. So I'm guessing that's kind of what impacted Wall Street to go into the red yesterday.
Well, it's interesting because, again, there's what he does and there's what he says. And so initially, with this 75 basis point hike and some of the remarks that were released, markets jumped a little bit higher. And then as he began speaking, we saw that markets began tanking pretty much out of every word he said. It might have been one of the costliest 30-minute speeches ever. Basically, he's saying the interest rates could go much higher than he originally projected, and that he will push them as high as they need to be. So a very expensive speech there for everyone in the economy.
Yep. Unconditional war on high interest, or on high inflation. That's what he said. That's Lydia Moynihan joining us from New York this morning. Lydia, thank you. Okay.
Thank you for watching. Go to newsnationnow.com to find NewsNation on your television provider. And don't forget to click the red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.